Gold usually loses less ground than silver. And then if history repeats or it rhymes, then what we'll see is silver actually overtake gold on the last leg up. And just to go a bit further, Ivan, if I may, and that is to go back to the 2008 financial crisis, silver was at a $21 peak. It bottomed under $9. And then from that bottom of $9, it made it all the way to 50.
Oh, wow.
About a 550, 550% gain. Gold, I forget the exact numbers, but it was, I think, about a 300% gain, if I recall correct. So silver definitely outperformed.
As experts begin to shift focus from gold's peaks to silver's potential, the metal is emerging as a key asset to watch in the evolving global market landscape. While silver has taken a sharp hit in recent sessions, falling in tandem with global commodities amid rising trade tensions and recession fears, analysts believe this correction could be a setup for a strong rebound. Silver has quietly positioned itself as a high-conviction play for 2025, often overshadowed by gold's rally, driven by its unique blend of industrial demand, monetary relevance, and undervaluation. With decades of experience analyzing economic trends, DavidMorgan underscores a familiar pattern where gold and silver stumble initially. Referring to the 2008 financial crisis, Morgan recalls silver plunging before rallying to $50, while gold rose around 300% over the same period. He notes that although silver has recently fallen below the $30 mark, it continues to show resilience. Based on market dynamics, Morgan emphasizes that while U.S. stocks seem stable in dollar terms, they've declined relative to gold. He cites a 20-year head and shoulders pattern in the S&P 500 measured in gold. This classic technical setup signals a potential long-term market top. Interestingly, Morgan points out that underlying risks remain even as stocks and gold hit new highs together. He warns that a stock market decline could hit pensions and bonuses hard, with the bond market posing the greatest threat. When markets realign, he believes gold is primed to surge. With an unprecedented global trade war underway, market volatility has been extreme. Stock markets worldwide and major commodities have been hammered on great uncertainty. But gold's star is rising, increasingly becoming the leading refuge amidst this chaos. Gold demand is surging as everything else burns, breathing new life into gold's remarkable monster upleg, which isn't yet done powering higher. Before we dive into DavidMorgan's sharp insights from his latest interview, make sure to hit that subscribe button and tap the bell icon so you never miss a moment when truth meets the markets. Let's get into it.
Well, from a big, broad brush perspective, probably the question I've gotten the most over the last 2 decades or so is, what happens to gold and silver if there's a big sell-off in the stock market? And the answer is the same. They will go down with the stock market, and they will be the first to recover. And you're seeing that same meme all over X. Jim Rickards posted something like that. I think Middle Coop has. Several well-knowns in our industry have made that statement, and that's basically is what happens. Gold usually loses less ground than silver. And then if history repeats or it rhymes, then what we'll see is silver actually overtake gold on the last leg up. And just to go a bit further, Ivan, if I may, and that is to go back to the 2008 financial crisis, silver was at a $21 peak. It bottomed under $9. And then from that bottom of $9, it made it all the way to 50.
Oh, wow.
About a 550, 550% gain. Gold, I forget the exact numbers, but it was, I think, about a 300% gain, if I recall correctly. So silver definitely outperformed. And gold went down, but not nearly the percentage that silver did. But silver did over 50% on that move down. But it's discouraging to silver investors because they finally get in the 30s, and we think, well, 30 is going to be the resistance. It's holding, and every day it prints over 30, the more likely that 30 will hold it. And then obviously it hasn't, but it's not gone much below that. But my point is this. It was up about 17% for the year, and that got wiped out in a matter of about 3 days. Yeah. That's discouraging. So, and gold is doing its job. I mean, everything goes down in a major sell-off. Gold went down, but it went down probably less than almost anything else you can name. So gold's definitely doing its job of maintaining stability in a very uncertain financial system. So one of the first books I read back here is called The Invisible Crash by Jim Dines. And it talks about the invisible crash in the stock market, because looking at the numbers of the stock market, it was basically going sideways when he wrote that book. But if you adjusted it in terms of the price of gold, it was going down and down and down. And that's what his argument was. It was an invisible crash. As you looked at it in US dollar terms, it was fine. If you looked at it in terms of gold, it was not doing well. It was crashing. Well, I did that same look at the U.S. stock market. I think I used the S&P 500 over the last 20 years. And I already knew this, but the stock market peaked in terms of gold in the year 2000. But what I
Right.
hadn't seen in a long time was what it looks like. It's a 20-year massive head and shoulders pattern. Head and shoulders patterns are pretty reliable for a top. I would say a 20-year pattern of that magnitude is probably a good indicator. The left shoulder's in, the head is in 2000, the right shoulder's been formed. It's topped and coming down in terms of gold. But to me, that's scary. So what scares you the most? The bond market's number one and the equity market's number two, because so many things are dependent on the U.S. stock market now. 401ks, bonuses for corporations, pension funds. I mean, all kinds of things are tied to the stock market. And if I'm right about that massive head and shoulders, and we've got a lot further to go to the downside, that does not bode well for the U.S., for the money markets, for the equity markets, for the ETFs, for investing in general, because most people are, whether they think they're in the stock market or not, people that own stock, still they are. But for example, people that say, well, I don't have anything in stocks, I don't care about the stock market. No, they do, because if they're involved in a pension fund or whatever, they are affected by the stock. Everybody's affected by the stock. So that's it, long-winded, but honestly. And then I guess one more thing, and that is the shift to where we see what kind of flows are going into gold. Now remember, if gold is the most negatively correlated asset to the stock market, and the stock market was making new high after new high not that long ago,
Right.
and yet gold was making new highs at the same time. Think about what that means. If it's the most negatively correlated asset and it's making new highs at the same time the stock market is, it says, well, I'm ready to go. You guys are so messed up and so bad and so mispriced
Right.
that when this thing comes back to reality, where do you think gold is going to be relative to stocks, relative to oil, relative to other commodities, and on it goes. So honestly, I do not like to scare, I like to prepare, but it's concerning. I'll use that word.
Reflecting on the complex role of tariffs, DavidMorgan notes that the global trade environment has been anything but fair. He remains cautious, observing the inconsistency in U.S. tariff policy and its potential as a trigger for deeper market corrections. Wall Street's gleeful embrace of the policy reversal reflected relief that Mr. Trump would not follow through with most of his plans for the tariffs, which had sent markets into a tailspin and threatened to upend global trade. Even after the president's partial U-turn, freezing tariffs at 10% on all U.S. imports except those from China for 90 days, markets swung from relief rally to fresh rout as investors questioned the once unthinkable: could the U.S. dollar be losing its unassailable safe haven status? If tariffs prompt a return to market reality, they might serve a long-term benefit, though not without significant economic pain. For now, DavidMorgan remains watchful and open to how the situation evolves. Let's get back to the interview.
Well, there would be arguments made both ways. I mean, you go back in earlier history when the United States basically didn't have like an income tax and used tariffs and seemed to work. World certainly changed a great deal from there. I'm for free markets, more of a laissez-faire approach. The problem with saying, fair markets is they weren't fair coming to the U.S. because most of these other countries had tariffs on their products coming in. So, what's good for the goose is good for the gander. We're going to put a tariff on us. We're going to put a tariff back on you. And then you go back to do two wrongs, make it right. So lots to think about. I think, first of all, I just published my latest, premium service, private cost, paid for newsletter. And I put a lot of thought into the editorial, which I actually did about the great taking. And in the final thoughts, which gives me the ability to write as much as I want or need to right before we publish, because in this volatile world, something could happen in any market, and there I am, and I don't have to rewrite the whole thing. I can just add on. So at the final thoughts, I'm standing not aside, but I'm watching and being patient about the tariffs because it's been very wishy-washy. Trump said they're on, they're off. No, this country's exempt. No, it's not. I mean, it's gone back and forth. So I'm just going to remain in that posture, but I'm not really answering your question. On balance, I think we're better off without them than with them. As far as what's the ultimate look at it, putting on my foil hat, the system is due to have a major correction. And if the tariffs are the mechanism that puts things to what we consider mark to market, where the true value of things are adjusted to reality, then in a way, I wouldn't blame the tariffs as far as doing something beneficial in the long run. The problem is, human nature, no pain, no gain. The amount of, I'll put quotation marks, pain that's required for the system at large is rather massive relative to the amount of fake gain that's been going on for probably 50 years since we left the gold standard or dollar standard. And that is saying a mouthful. But if you go back to 2008, and rather than paper that over and admit that we had printed way too much, valuations were ridiculously high, and taken the medicine then, we would be in far better shape now. But no, we don't. We keep papering it over and over, and sooner or later it's going to explode. Is this a trigger mechanism? It may very well be, and I'll just go one step further as I adjust my hat, and that is that may have been from the, I'll call it, upper echelon part of the reason for these ridiculous numbers. I mean, 50% on China or 52%, I'm going to double it to 104%. I mean, come on. So, but that's it. So I don't have a really great answer, but I'm still thinking about it. I'm still watching it. And, the next time we interview, I mean, the story could be completely different.
Right.
Tariffs are, there aren't any, I mean, I wouldn't say that, I wouldn't go that far, but they've been adjusted substantially and on it goes. But, these other countries do have pressure on them to accept it because the U.S. is by far the biggest market. If they can't export to the United States, what are they going to do? They're sort of more or less out of business. So if you've got to pay a fee to stay in business, called a tariff, but you still have an export market in the United States, well, a lot of countries are going to say, okay, I guess we'll do it.
Sentiment seems to suggest that silver prices could continue to rise this year, according to a survey from Bullion Vault. As market distortions unravel and precious metals regain prominence, are you positioned to protect and preserve your wealth when the next reset hits? We would love to hear your take. Share your thoughts in the comments below. If this video sparked new insights, show your support by hitting the like button, subscribing, and turning on notifications so you never miss a beat in the world of finance. Until next time, stay informed and stay ahead.